In the years ahead, Europe's biggest industrial superpower will face an economic reality it hasn't lived through in more than half a century. Not because of a sudden market crash, a banking panic, or a temporary break in the supply chain, but because the three pillars that built its modern wealth collapsed all at once. There's a line drawn across Germany's economic charts that sums up this entire crisis, and, like the gauge on a factory grinding to a halt, it keeps pointing down, faster and faster. For decades, Germany operated as the undisputed financial engine of the European continent, generating nearly a quarter of all wealth produced in the European Union on its own, a trade surplus above 200 billion euros every year. But almost overnight, that perfect machine broke. Cheap energy evaporated, the country's biggest customer turned into its most aggressive competitor, and German factories started losing the technology race. What happens when the industrial workshop of an entire continent starts closing its doors, and how is this collapse affecting the world economy? To understand why this decline is nearly impossible to stop, we need to go back to a moment when the German machine seemed perfect. After being destroyed in World War II, West Germany built what the world came to call an economic miracle. But over the last 2 decades, that miracle got simplified into a formula that seemed foolproof. The formula was brilliant in its simplicity. Cheap Russian natural gas covered more than half of the country's entire fuel consumption at cost price, delivered straight through pipelines. That mattered because energy is the input that decides whether a factory competes or closes, and Germany had the cheapest input on the continent. With that energy, the country turned raw materials into heavy machinery, chemicals, and luxury cars, some of the highest value-added goods that exist, and sold it all directly to China, which bought billions in German equipment every quarter to build its own cities. For 20 years, this system ran like a Swiss watch. Government coffers overflowed with budget surpluses, export profits paid for flawless roads and schools, and German workers enjoyed some of the highest wages and strongest job protections on the planet. It was the perfect industrial dream. Almost no one questioned the formula. Germany became the armored workshop of the world for high-tech goods. The problem is that nobody noticed the trap at the bottom of the recipe. All that wealth depended on raw materials and customers that Germany didn't control. The first pillar collapsed as violently as possible. Making steel, glass, fertilizer, or chemicals requires massive volumes of energy running nonstop. For decades, more than 55% of all the gas keeping Germany's industrial parks running came directly from Russian pipelines under the Baltic Sea. When geopolitical tensions shut off those taps, Germany watched cheap fuel vanish overnight. The emergency fix was buying liquefied natural gas shipped in from the other side of the world. But the logistical bill for that improvisation was brutal. On paper, electricity costs for German factories skyrocketed, ending up nearly 3 times higher than what competitors in the United States or Asia were paying. That means a German factory and an American one could make the exact same product, except one was paying nearly triple just to keep the lights on. The math of heavy industry is cruel. If a German factory has to pay nearly $3,000 for the same energy an American factory buys for $1,000, the profit margin disappears. No level of engineering excellence can cover that gap. Overnight, the cheap fuel that built German industry was gone. For the sector's giants, the choice became a matter of survival. Shut down historic production lines in Europe, or take billions in planned investment and build new factories in countries where energy doesn't cost a fortune. While the energy bill was choking companies back home, the second pillar was crumbling thousands of miles away. For decades, China was the golden goose for German automakers and manufacturers. As the Chinese market grew, brands like Volkswagen, Mercedes, and BMW sold millions of cars to the country's rising middle class. But there was a quiet turning point the West was slow to see. The Chinese didn't want to just be customers. They studied German technology, received heavy state subsidies, and built their own large-scale supply chains. Before long, Germany's biggest buyer had become its biggest rival. Nowhere was this more visible than in the auto industry, a jobs engine that directly supports millions of German families. When the world accelerated toward electric vehicles, the Chinese were already years ahead. In China itself, more than 60% of electric vehicles sold are now local brands. The German automaker, which used to sell there almost without competition, became a supporting character in the very market that had sustained it. German brands' share of the Chinese market fell from around 25% to close to 15% in just a few years. To make things worse, those same Chinese electric vehicles started showing up in European dealerships, costing considerably less than models made on German soil. A European consumer today can buy an electric car that's cheaper and more advanced, and it isn't German. The trade balance flipped inside out. Germany's trade deficit with China hit tens of billions of euros because Beijing stopped buying European machinery and started selling its own products inside Europe instead. The world's factory doesn't need the German teacher anymore. China learned to do what Germany taught. Germany hasn't yet learned to do what China discovered. When energy gets expensive and customers disappear, the bill lands directly on the factory floor. German industrial production has already fallen more than 10% from its best moments. Words that once seemed unthinkable in boardrooms are now routine in the news. Cost cuts, halted investment, mass layoffs. This is the start of what economists call deindustrialization, when a country loses its factories for good. Industry surveys show that 1 in 3 major German companies is already planning or already carrying out a move of operations out of Germany to North America or Asia. This isn't a temporary adjustment, it's capital leaving the country that rarely comes back, taking jobs and technical know-how with it. And the crisis isn't only coming from outside, the internal structure is crumbling too. Germany faces a demographic time bomb. The generation of older workers is retiring en masse, and the projection is that the country will lose between 3.5 and 5 million workers from its active labor force by the middle of the next decade. It's as if the entire workforce of a mid-sized country simply vanished, with no adequate replacements. Meanwhile, gridlocked bureaucracy forces companies to wait months for basic paperwork approvals. The damage is devastating for the Mittelstand, the more than 3 million small and mid-sized businesses that employ more than half of all German workers, and that today can't absorb the cost of energy and taxes. Official data lays the damage bare. After 2 straight years of recession, the German economy barely grew 0.2% in 2025. An economy the size of Germany's doesn't stall for 2 years running by accident, it's a sign the engine stopped, not just sputtered. In 2026, growth is projected at just 0.6%, a real recovery, but still a fragile one, far from the pace Germany sustained before the crisis. Facing such a grim picture, the obvious question is, why doesn't the government in Berlin inject billions of euros into the economy to save its factories? This is where the great paradox of the German system comes in. Political leadership admits the economy is in critical condition, but the government's hands are tied by a legal constraint it wrote into its own constitution in 2009, the Schuldenbremse, or debt brake. That rule strictly bars the government from running a deficit larger than a mere 0.35% of GDP. In practice, it's like putting a speed limiter on the machinery of the state. The problem is that while the United States and China pour hundreds of billions into subsidies to attract industry, Germany is legally barred from doing the same to protect its own. Competitors enter this race with a full tank. Germany enters with its engine legally capped. This has triggered a political war in Berlin. On one side, austerity advocates say the country's debt, currently around 63% of GDP, needs to stay under control to avoid a future collapse. On the other, industry leaders have already won a partial victory, a special €500 billion fund to modernize the power grid, the railways, and the country's digital infrastructure over the next decade. To try to put out the fire without breaking the law, the government has approved temporary fiscal relief packages. But that's the equivalent of putting a band-aid on a compound fracture. Temporary help doesn't lower the structural price of energy, nor does it bring back the customers German factories have already lost to China. For more than 40 years, the world ran on a predictable arrangement, cutting-edge German engineering powered by cheap regional energy, supplying consumers in America and construction sites across Asia. It was an export machine worth more than 1.5 trillion euros a year, sitting at the center of world trade. Today, that arrangement has come apart irreversibly. Germany's crisis isn't an ordinary cyclical recession, it's the structural breakdown of the country's own business model. When Europe's largest economy loses steam, the shock reverberates around the world. Neighboring countries that produce parts for German brands feel the impact almost immediately. The European bloc becomes more unstable, while global trade shifts toward new economic powers in Asia and North America. Germany has risen from the ashes before, and it still has valuable strengths: strong institutions, world-class research centers, and generations of accumulated technical expertise. But the era of certainty, cheap energy, guaranteed customers, and automatic growth has definitively come to an end. Subscribe to the channel to follow our analysis, and let me know in the comments below, will Germany manage to reinvent itself in time, or has Europe's economic engine already entered an inevitable decline?